In this inaugural vignette on investment concepts, we'd like to talk about the importance of capital allocation, particularly in capital-intensive businesses, as well as the importance of investors paying a good price for an asset. And because this topic is so popular with GreenWood investors, we'd like to illustrate this concept using a familiar business in Fiat and contrast it to its feuding rival to the north in Volkswagen. Clearly, the auto industry requires a substantial amount of capital, and this requirement makes good investment decisions far more important than in most other industries. So when you think of Volkswagen, most people think of sleek cars that rule the Autobahn, whereas Fiat conjures up cheap and cheerful images that wouldn't necessarily resonate with it being a good competitor. But Piche has met his match in Marchionni, who has put up returns that the Germans must have been paying attention to. Despite enacting a similar strategy of manufacturing different brands under the same roof, Volkswagen uses a substantially higher amount of capital to produce each car than Fiat does, nearly $17,000 per vehicle versus Fiat's $9,000. But Volkswagen earns more on Audis and Porsches than Fiat earns with Jeeps and Fiats, right? We're afraid not. In 2013, Fiat generated €200 more per car in cash than did VW. Thus, Fiat's cash return on capital has smoked its German peer, hitting nearly 20% last year versus VW's 10%. Now, because the trading of stocks involves emotion and a lot of bad decisions, what we pay for the stock often doesn't correlate to the capital invested in the business. It just so happens that if we adjust for debt, the market cap of both stocks trades well below the invested capital in the business. And while we're not suggesting that this discount will narrow with any specific timeliness, paying a cheap price for a stock turbocharges the returns on investment we experience as a result of the company's own return on capital. We've adjusted the typical ROIC to incorporate how much we paid for the asset, as it more closely resembles the return on our own invested capital, given we are paying a substantially less for the asset than a new entrant would pay. Now, adjusting the company's ROIC for the price we paid, we can see the return on our invested capital becomes magnified to 20% for VW and a substantial 63% for Fiat. Now, because all of this cash isn't coming back to us shareholders, in fact, none of it is, as both companies are going through a robust investment phase, this investment means that the returns management gets on the company's cash invested will drive a substantial portion of the stock's longer-term returns. It's important to note also that the cheaper a company is, the more important capital allocation will be on future returns. To illustrate this point, let's look both at Fiat's and VW's capital spending plans over a 4-year period. Both companies' market caps as well as their respective spending is presented to scale by the cars and the cash. What's obvious is that both companies are spending a bundle on their products, but Fiat is spending a disproportionate amount of money relative to its own market cap. Thus, what Sergio does with all of this cash will have a more dramatic effect on the stock price than VW's. Sergio's publicly stated goals imply a 19% return on the capital spent, while Volkswagen has said it is targeting a 16% ROIC. Though a few internal leaks to the media have highlighted that this may no longer be achievable by next year. And in fact, since the start of VW's own plan, its returns on capital spent have been negative. But let's just say both management teams hit their goal. The growth in the car size represents the opportunity for the stocks to appreciate at the same rate, keeping the discount to capital stocks steady. While analysts may doubt that Fiat's and VW's goals are achievable, both management teams have publicly committed to the goal and no doubt believe they are achievable. Given Marchioni's plans imply a future value north of €50 per share for Fiat stock, he can fall well short of his goals and we will still do quite well. It's interesting given the rumors in the press that VW is looking at acquiring Fiat, as it would seem like a great way to fix the relative underperformance. Except for one little detail. Much of Fiat's performance comes not from its assets, but from a great caretaker in Marchionni himself. If we just look at the historical and future payments both Chrysler and Fiat have paid to merge the two entities, it adds up to just $7.7 billion, which means Sergio negotiated the acquisition of an asset at a price which implies an astounding 77% annual cash return on invested capital. When Sergio took the helm of Fiat in 2004, the company was generating less than a 3% return on capital. Yet since then, he has spent roughly €47 billion, which includes C&H, And by spending this 47, he has improved cash flow by nearly 10 billion euro. That's a 21% incremental return on capital, which has lifted Fiat's cash flow to today's levels. 2004 marks an interesting year for both companies, as Volkswagen delivered about 5 million vehicles in the year. That's just over Fiat's estimated 2014 deliveries, despite the fact that it earned less than 2/3 of the cash flow that Fiat will do this year. Since then, the company has invested 100 billion euro, which has helped double the number of cars it sells. By investing this 100 billion, it was able to lift industrial cash flow by approximately 9 billion euro. That's a 9% return on invested capital. But because this company was trading at a substantial discount to its invested capital, investors have still done very well on VW over the last decade, with preferred shares rising nearly 7 times since then. Thus, the 9% ROIC was actually far higher for shareholders getting the assets for a pittance. The return on the stockholders' capital ended up being 24% compounded over the last 9 years. Clearly a much better result than what VW's own management team has been able to deliver. So if Fiat more than doubles this return on invested capital, does that mean that we could see the same appreciation in half the time? Over the short term, that will be determined by this zoo. But over the long term, it will be determined by this guy.